I'd paused it. Okay. Starting over. So some of this is inspired by the webinar I recently did on starting or restarting your accounting or bookkeeping practice. Some of it is inspired by something I have yet to publish called Why Your CFO Services Might Be Worthless. And of course, that title is a bit of clickbait, but I do have a point and I will make it. And that came from something I had seen online where somebody was talking about, how to provide CFO services. And it just, as I was watching this guy's video, I was like, there's a very important underlying point that I just felt wasn't being made. And so that's how a lot of stuff that I do gets inspired. I see something somebody else is doing, and quite frankly, I feel like I can improve upon it. So let me turn off the enter exit chime. Okay, perfect. All right, so I will dive right into it. So this is, of course, on what's wrong with that profit and loss statement, right? And the idea, and everybody here who's here live with us is an accountant or bookkeeper, right? So you're going to get it. Obviously, I'm sure you've had your share of sets of books that come in the door. As we were getting started, I was literally responding to my friend Mike Russo, who's a CPA in New Jersey, does taxes, and we were having this conversation because somebody had posted the question that her clients' books have a balance that one of their customers didn't want to pay for like $200. And should she write it off? And of course, all the tax prep people were like, no, you can't write off. There's no bad debt. It's cash basis. And my comment, of course, is you guys are only thinking of the tax returns. These guys still have a business to run all year. They just can't let a receivable like that sit in their books permanently. It has to be written off. I get that for tax purposes, you wouldn't acknowledge it, but it has to be addressed. And and so of course the conversation continued, and actually Mike went as far as to say, no, I would just adjust the invoice to agree with what was paid. And I said, but as the CFO, that's not what I would ever want to do. I want the record. I want to know that we charged them this amount. They didn't pay us. They stiffed us. And so we had to write off that difference. I need to know what the story was, because that's going to be a strong indicator for if and how we might do business with that client going forward. We might say, sure, we'll do business with you again, but you need to pay us that $200 that you never paid us, right? Or I might just, I've years ago, a friend of mine who had a catering business was sharing with me how one of his clients, really screwed him, frankly, and didn't pay him a lot of what they owed him. And I said, well, why don't you go after them and put them into collections? He's like, no, I know they'll hire me again and I'll just get them on the next round, meaning he was just going to jack up the prices on them to make up the difference. And I thought, that's actually a clever way to do it. Rather than get into the animosity of sending someone to collections and paying the cost, if they're going to come back to you for more, then you just make it up. The bottom line is I need the whole story. I get that the tax preparing professionals need to do what they need to do for the taxes, but as the CFO or even just the bookkeeper who's managing the books, I need the whole story there. I need to know, what's going to happen. And so, going back to the video I was watching about how to provide CFO services, the guy I was watching was going through, how to analyze a P&L, and, assuming the premise of the whole thing is a client coming in with the question, how come I'm not making as much profit as I think I should, right? And he starts going through how to analyze the P&L, which I'm going to go through here. It's kind of my version of how I would do what he was showing. But I want to underscore all of this with the important point of making sure that we're very clear. And this is what I mean when I say your CFO services might be worthless, that before we analyze anything on the P&L, we have to know that the information we're looking at, as I could see from the nodding heads that everybody's agreeing, we have to know that the information is reliable. We have to verify it. We have to perform some kind of a review or audit. I know people don't like that word audit. It's a scary word. And I don't mean a certified audit. I mean just like an internal review and just verify the numbers, beat up the balance sheet, make sure that those bank account balances are accurate, that the receivables are really receivables. I mean, every week it seems I look at another set of books. This week, no exception. The other night I had a new client coming in the door and asked me to, take a look at things. And sure enough, I see undeposited funds going back to 2016. And I know what that means. I know that we duplicated income, 99% chance. I would bet money that we duplicated the income because we've, the bookkeepers and accountants that I talked to, we've all seen it before. It really, usually what it means is we got the invoice recorded, we applied a payment, left it sitting in undeposited funds, the money went into the bank, and we booked that straight to income. And now we have it twice, once on the invoice, which is going to show up on a cash basis because payment's been applied, and a second time in the bank account directly. So we've doubled our income, and we've overstated our assets on the balance sheet because that stuff is sitting in undeposited funds. So there's all kinds of things wrong. And I wrote back to the client and, pointed all this out to him and, explained to him that, here's the fee for what we're going to charge you for the monthly bookkeeping going forward, but I also need to charge something extra for the cleanup on this stuff, And I made that very clear. So going back to that, sort of CFO question of why am I not more profitable, or how can I be more profitable? Right. And this, by the way, is where if we're talking about how to be more strategic in terms of providing services as bookkeepers and accountants, this is what we want to start doing for clients. We want to start analyzing their profit and loss to see how can I get more profitable. Right. And I like to sort of reverse engineer this because it keeps it real simple. Right. So how do I get more profitable? Well, let's state the obvious. I need to increase the net income figure. Right. And let's keep stating the obvious here because sometimes that's what we need to do to sort of back into the work. Right? The work being what we ultimately need to do to accomplish that increase in the net income. So obviously we need to increase the net income. How do we do that? Well, by reducing expenses and by increasing revenues, right? And sort of in the middle of that somewhere is also increasing the gross profit if there is one, right? If we're looking at cost of goods sold and, increasing that. That's the simple formula to the P&L that we all know, and that's what needs to be addressed. So the question is, all right, what should we focus on first, right? Well, in my experience, I've often, come to the conclusion with lots of the businesses that I've worked with that the expenses are generally easy enough to manage, right? I can go through the P&L. Usually I'll run it year to date and total it by month so I can analyze the trends and see where are we spending money pretty consistently. And pretty quickly I can determine where in the expenses we can cut back, right? Of course, this is all assuming we've done the cleanup work and actually reviewed the books and, so that this all assumes that what we're looking at this point is actually accurate. But I can quickly see, there's certain things we can't reduce. Payroll, I'm not going to look to reduce, unless there's a really good reason for cutting staff. But to me, that should always be a measure of last resort. Never want somebody to lose their job unless they really need to, right? But we look at other areas where can we cut back? Where are we spending money that we don't need to be spending? This is why in a lot of my Bulletproof Bookkeeping social media posts, I talk about the fact that, a lot of times we don't look closely enough and we'll see a charge come through on a credit card or in a bank account for a gas station and we just assume it's fuel, but it might not be. It might be food, right? And that's important to know because I'm trying to do this kind of analysis and trying to see where can I cut back on the expenses. The food is likely the first place I can cut out. I can say, let's stop. If we're looking to, bootstrap and really try to be as lean as we can, we don't need to buy food. Everybody can buy their own food and bring lunch from home, whatever. It's not a necessity. Whereas the fuel might be necessary because we might need to have people out on the road visiting people that helps drum up business, and that's also something that needs to be analyzed. Where are we spending money on fuel? Is it the owner just buying all of his own gas, whether it's for business or personal use? We've seen that, right? So we can analyze that, but the point being that that's why it's so important to be so detailed about booking these things and actually look at the receipts and see what should go to meals versus fuel, because then I can more clearly see where the opportunities are to cut back on things in order to increase the profits, right? So I feel like the expenses are pretty easy to figure out and control and manage, right? It's the other side of it that gets a little trickier. And this is the part that I went over a little bit last week, which is, there's 3 ways to increase sales, right? There's literally just that. We can write all kinds of articles and go online and probably go onto Inc.com and Fortune and Forbes and all this. And there's probably a million articles with variations on the themes, but there's really 3 ways that we can increase sales, and that's it, okay? And so how do we do it? Well, we can get more clients, right? And to do that, we're probably going to need to spend money on advertising or marketing of some kind, right? We can raise prices. Hard to do, but there's a strategy around this that I'll talk about. Or, and this is the kicker, we can increase the number of times somebody buys from us, right? Those are the 3 ways. Any article you read about it, how to increase sales, it's going to be some version of one of those 3, or maybe a combination of 2 or all 3 of them. So, but those are the ways you can increase sales, bottom line. And I realize it's very sort of raw and foundational, but that's the point, is we want to approach it from that perspective. We want to be raw and foundational in how we look at this stuff, right? So the first thing is, and again, thinking in terms of what's wrong with this profit and loss, assuming we've done the reviews and made sure everything's accurate, then we're looking at the profit and loss, and it's a matter of coding and classification, right? Are things classified correctly, which goes back to the whole fuel versus meals thing, right? And there's other versions of that, obviously, across the whole P&L. So when we get down to this point, how do we increase sales? Well, increasing customers and using the method of bringing in more customers, again, that's probably going to result in some kind of an increase in expenses. And that's fine. There's nothing wrong with that. But as the CFO or the strategic advisor, what we want to be able to do is analyze what is our expected ROI, right? If I go out and spend money on Facebook ads, I want to know that for every $1,000 I spend on advertising, and I might be spending another $500 or something on a consultant every month who manages that Facebook advertising, whatever it is, I want to know if I'm spending total all in each month $1,500 on Facebook advertising, then I want to know that I'm bringing back, twice that, right? I want to double my money, basically. That's often going to be my approach. And, so when we engage somebody to do this, that's what we want to be looking for. And we need to have that concrete, right? We need to have that in black and white somewhere that this is our expected ROI. So we give them maybe 2 to 3 months to perform. And then at the end of 2 to 3 months, we analyze it and say, well, here is what we've spent, and here are the new clients that came in as a result of that expenditure. And in the past, it was a lot harder to track that. Now it's very easy. I mean, in my own case, a lot of people who sign up for these webinars are signing up through a series of Facebook ads that I'm posting. But when they click on those ads on Facebook, they're taken to a separate form so that when they fill out that form, it tags them. And it tags them based on the name of the agency that I've hired to help me with the Facebook ads. So I know exactly who's come in through their efforts. And I can go into my website's backend and run a report, and I can run a report that says, show me all the people who've signed up for any product, or, in this case, the main product we're frankly looking to promote here is my Bulletproof Bookkeeping course. And so I can run a report that shows me all the people who've signed up for that course, and then filter it further for people who have that tag, right? And so this is how we, these are the kinds of systems we need to set up for ourselves, but also for our clients if we're being engaged as the kind of CFO person, right? Now, you may not have all the technical expertise to know how to set up that kind of a workflow that I talked about, and it may not necessarily be something you want to do. I enjoy doing that kind of stuff, but if it's not you doing it, at least you should be advising the client that this is what they need to do, right? They need to find somebody if they can't do the advertising themselves, and they need to make sure they have a good tracking system in place so they can track the results, right? I love the phrase. I read it somewhere online recently, and I've been repeating it constantly because I just love it so much. It's, if it's not measured, then it can't be, I lost my train of thought.
Managed.
Managed. Thank you.
You're welcome.
Thank you very much. Who said that?
It was Courtney.
Courtney, thank you.
Yes, you're welcome.
Yes, if it's not measured, it can't be managed. I just went into a total blank spot there.
That happens to me all the time.
Yep, I think it's because I'm getting
senior moment.
I was just going to say, I'm getting old. It's the gray hairs. It's all that. Yep, if it can't be measured, it can't be managed. So, so I need that tracking, because that's the only way I'm going to know if I do spend money on advertising and marketing, if that money's doing what it's supposed to, right? Everything I spend is supposed to come back to me and then some, and then we look at things like the speed of cash, which says from the moment I put $1 out there, how long does it take to come back to me with that profit attached to it, right? And it's really easy to understand and analyze that when you're dealing with a business, for example, that sells inventory, right? Because a lot of times these days, especially, I think more than ever, if we have e-commerce clients like I do, we're sending money out today to pay for product that's being shipped from overseas. It might take 2 weeks before that product gets to us, right? It might take another month before that product gets sold, and of course we ship it out, right? But so when we get that sale, there's no receivables turnover because we sold it online, we got paid immediately, but there's still the time from when I put that $1 out to the time that item got to me and then got sold that we want to analyze. What's my speed of cash? And that gets used in determining how much money do I need to have in the bank today, right? Because I need to know how much working capital do I need to have liquid in the bank in order to make sure that I can buy all the inventory I need. Because the worst thing we can do from a management standpoint in a business is lose a sale because we were understocked in something, right? And of course, in a service-based business, our inventory is our labor force, right? That's the part of what's on the P&L that salaries expense that's generating the revenue, right? That's what we're sort of churning in a sense. So, when you're thinking of a service-based business, that's where we need to shift our mindset a little bit, right? So analyzing a profit and loss, what's wrong? Well, we're not making enough money. Why aren't we making enough money? Is it a pricing problem? Are we not charging enough, right? Or maybe we know we're going into this with a small margin because we're expecting to sell high volume, right? These are the questions we want to start asking and analyzing to see, starting from literally the very top of the P&L, right? So maybe we do need to increase prices. Maybe we're not charging enough. Maybe we need to increase volume, which goes back to probably need to do some advertising and marketing to sell more, and that's going to increase that inventory turnover number, right? Which is also going to increase, which is probably actually going to decrease the speed of cash, meaning we're going to need more cash available to buy more inventory more often because we need to make sure the inventory comes in quickly enough to meet the demand. So we can do that. And the other thing to do is we can look at our cost of goods sold, right? Earlier this year, political leanings aside, I have no interest in having a political debate with anybody, but the simple fact is it's costing more to import from China, right? And so I had advised one of my clients, a lot of whose products had been coming in from China. I said, you need to start looking elsewhere because they're going to start raising prices because they got to make up for the tariffs that we're imposing on them. I don't care if you agree or disagree with it. This is just a fact, right? And so that's, and as far as I know, he hasn't reported back to me. I'm almost assuming it's because he's gotten busy as a result of that guidance I gave him, doing the research and figuring out, because I said, guaranteed your gross margin is going to shrink up quickly if we don't find a way to manage to control that cost of goods sold. That's the other lever that we can pull in our, in our revenue and gross profit piece is trying to see what we can do to lower cost of goods sold. Now, sometimes we can lower cost of goods sold by taking advantage of a volume discount. In other words, the supplier will come back and say, well, buy more and we'll charge you less per unit. And that can increase your cost of goods sold, provided you can actually move the goods, right? So we don't want to overstock just to get a lower cost of goods sold, because if we wind up having to write off obsolete inventory that we can't sell, then that's going to raise our cost of goods sold in the long run, right? Instead of lowering it, which was the intention. So that strategy really only works if we know we can move the product, right? If we know that we can, even if it means buying more, we lower the cost of goods sold, and then maybe we raise the prices at first, wait a month or 2 or 3. We've all seen retailers do this if you pay attention closely, and then we run a sale, right? And so when we run that sale, we're really getting the prices back to what we normally would have charged, so we still have that extra margin in there, right? So again, these are, we're not going to be experts on these products or these industries per se, but this is the kind of guidance we can give to our clients. This is when they come to us and say, I want you to be my CFO. I want you to give me that strategic guidance. This is the stuff we want to look at with them. And again, I want to go back to the beginning and reiterate how important it is that before we do this analysis that we have to make sure it's all accurate, right? Because if I don't have accurate cost of goods sold, then none of this is relevant, right? I mean, we might get lucky kind of by throwing a dart at the board, and maybe we'll increase profits and improve cash flow just because we lowered cost of goods sold and the general trend was down. But really what we need is very accurate information, so I know exactly what my cost of goods sold are, right? And at some point, we may have to live with doing some allocations, right? We might have things like logistics costs that we can't necessarily allocate per unit. It wouldn't be cost effective to do so. So we have to come up with some kind of an assumption, right? Logistics costs are generally driven by weight, right? So you can't just say, well, we paid X number of dollars for the shipping and I shipped this many units, let's just divide it out. Doesn't work like that. To do it properly, if you were going to do a specific unit allocation, and this is management accounting stuff I'm really talking about here, like deep management accounting stuff. If we wanted to do a specific units allocation for logistics, we would have to get a list of everything that was on a shipment and what its weight is, and then we could prorate it based on weight, right? But again, in most cases, it's not going to be cost effective to do that. To have to do that on every shipment that comes in ever, I can even create a template in a spreadsheet where I can drop the information in, and maybe I can even get the information in a CSV from the supplier. It's still probably not cost effective, even though you can get good and efficient about doing this. Might be, but unlikely, right? So we'll have to do some kind of an assumption. I have a client where I do this with, where when we pay for the logistics costs, I said, let's come up with a good rough average number about how long it takes to move that inventory when you ship it in. And basically what we came up with, he and I kind of, racked our brains together on this, is we said, from the day that it comes in, we'll allocate 1/4 of the cost to cost of goods sold, and the other 3/4 evenly over the next 3 months. Right? That's what we assumed, in other words, that about 1/4 of the inventory would move in the next month, and so on accordingly, right? And in this way, it's very easy for me to do it, because all the payments go to sort of a WIP account on the balance sheet, right? And then what I do is I go in periodically and I dump that in, all the new payments that went into that account, into a spreadsheet. The spreadsheet does the calculations, and the spreadsheet is also set up so that in a matter of minutes, I can import the journal entries off of that spreadsheet right into QuickBooks Online. So what if you did it manually would take hours to do, I've got done in 15 minutes, right? And that's the key to a lot of this, is building those systems and processes that make it really easy to do it very efficiently, right? And that's what I do. So in fact, I let it go for a couple of months, and he recently reached out to me on Slack and he says, our logistics WIP account hasn't been updated in months. I said, hang on. 15 minutes later, I go, refresh your screens. It's all done. It's all up to date, And the beauty of it is it's accurate to the penny in terms of the process we created, right? There's no room for error because I'm not calculating anything. I'm letting the spreadsheets do it, right? And by the way, it's all done in Google Sheets. So he's in QuickBooks Online Advanced. So they now, for QuickBooks Online Advanced, they have the export directly to Google Sheets, which makes this process even easier, right? So anyway, so again, going from the top, we're analyzing sales. Can we increase prices? Obviously, we have to balance that. We have to know our market. We have to know our competition. If we price it too high, especially when you're selling on sites like Amazon a lot, very easy to price shop, right? So it's hard to compete on price. You have to make sure you're charging on par with what your competition is charging. And keep in mind, it's regional, right? That's why Amazon has warehouses everywhere, and that's how they're able to ship same day or next day in a lot of cases. So when you're searching Amazon knows from your IP address where you are. They're going to serve you sellers that sell the same products that are local to you, because that's where the warehousing for those sellers is going to likely be in a lot of cases. So, keep all this stuff in mind when we're analyzing this stuff, right? And so, backing up a bit, because I kind of glossed this over as I'm looking at my notes, before any of this, obviously, and after we've verified that the books are bulletproof, we want to understand, how do our clients make their money, right? What do they sell? And then we get into what I did kind of go right into, which is, how much do you sell each unit for, right? And that's where you get back into those questions. Can we increase the price? Can we figure out a way to lower cost of goods sold? If the answer to lowering cost of goods sold is a volume discount, can we justify that based on, a reasonable expectation that we can move all the inventory, right? Even if it takes a little longer, it might be worth it. And then the other thing is cash flow wise. Can we afford to, remember, speed of cash? If we're going to lock up more cash in inventory to take advantage of this volume discount, can we afford to do that? Do we have the cash flow? And again, here's where your advisory services can really come in, because you can use something like Fundera, right? Where Fundera will pull all the data you need from your QuickBooks Online company and pretty much source loan applications for you among many lenders. And then you can figure out how best to line up the financing for them. And obviously the best approach here is to get a line of credit for the client, so they only use it when and if they need to, keeping in mind that once you do get a line of credit, they generally want to see it being used. If you let it sit sort of dormant, they might give you a hard time. But the point I want to make clear is the time to get the financing is when you don't need it, because that's when you'll get favorable terms on that financing. And that way you have it so that as you do the research and you see, hey, we can take advantage of a volume discount, but we need more cash and we don't have enough in our general working capital. Great, we've got this $100,000 line of credit. Let's use that, right? And then keep in mind that when you're doing that, in addition to your cost of goods sold, you have to factor in the interest cost because you're financing the purchase of that inventory specifically. But if you ask me, that's a really good use of debt potentially, is financing the purchase of inventory to keep your free cash flow available, right? But do factor that in. That in effect, that interest should almost go into a line item in the cost of goods sold section because it's specifically and only used in connection with purchasing inventory, right? So, like I said, if the strategy is going to be increasing sales, then we're looking at spending, and that might turn into a strategy for increasing sales, right? Because we just committed to buying more inventory, we want to blow through it. We might have to do some advertising again, to increase sales. And keep in mind, so speaking of the advertising, and again, I know that we're accountants, we don't want to be pay-per-click experts, but you should just have a working knowledge of what's out there and what the options are so you can have these conversations with the clients, right? So it could be pay-per-click advertising, but more and more these days, we're getting into things like influencer marketing, right? I have a new client right now who he's looking to blow out inventory based on a company he purchased. And once that inventory is blown out, he's going to find a new manufacturer to get the same product made less expensively, right? So these are the strategies he's employing. He's trying to lower his cost of goods sold. But then he's going to, his plan is to use influencer marketing. He's going to try and get famous people to, kind of show or use his product to try and boost sales. And you see more and more of that. I mean, you just go on Instagram. Instagram is riddled with this kind of stuff, right? That's how a lot of companies get their products and services sold, is by getting a well-known celebrity to endorse it. And I'm using the term well-known celebrity loosely. There are people, we think of well-known celebrities as like movie stars, but there are Instagram influencers who have gotten famous on Instagram, built a following, but those people can be hired and sometimes to a good effect. I'm sure you have to be very careful about who you align yourself with. I was reading articles recently about some of the scandals. Some of these people are getting sort of caught because their supposed lavish lifestyle where they do all this traveling is fake. They just put fake backgrounds on and make it look like they're laying out and lounging by a pool, right? That's what Connie's doing. She looks like she's at the beach. Connie might be an Instagram influencer. Look out for her. No. But, so we do have to be careful, but you should understand that these are some of the options that your clients have there. And now Greg's at the Golden Gate Bridge. That's weird. He flew there quickly.
Well,
was that WestJet?
It's only 30 minutes.
Okay.
Drive,
Okay. Fair enough. So, and this is a part, by the way, where the CFO services, depart from marketing and search engine optimization. And so this is where you're going to recommend to your client, that they hire somebody who knows what to do in today's world, for their kind of company. You're a CFO, not a marketer. So your job stops there at analyzing the numbers and determining this is whom we need to hire. This is a good use. This is a good way to spend money because it will bring in the sales. But then, like I said, you go into it having established exactly what the ROI needs to be. And then you make sure that you have the systems in place for tracking that. Right? If we hire that influencer, we need to have a way of tracking how many sales came in through that influencer. And a great way to do that, like I said, is to somehow have all roads that are sort of laid out by them lead to some specific page on your website or form like I do, so that as when you have a form or a page set up for that specific purpose and you measure that traffic, you know that there's only one place that came from. I mean, sure, there's possibility that other people landed there by accident somehow, but unlikely. And by and large, it's as good as you're going to get in terms of being able to track that kind of stuff. Right. And it's important, I think, to mention this, we have to know our limits, right? We don't step outside of our zone, even if we think we have some knowledge. Like, I have some experience. I've done a lot of my own sort of work on this because, frankly, I didn't want to spend the money until I realized I needed to. After I threw away thousands of dollars on Facebook ads and realized I have no idea what I'm doing, I realized I better just hire somebody. I could probably take some courses and learn, but I don't have time for that. My time needs to be spent developing content. That's what I do, and that's what I do really well, right? And for you guys, it's going to be doing taxes or bookkeeping or what, that was one thing I really tripled down on, this year, especially more than ever before, is I said, I have to stop spreading myself out and trying to do all these different things and suck it up and hire people and do what I do really well. And then I'll be able to afford to hire those people, no question, and that has proven to be true. So know your limits. Don't step outside your zone, even if you think you have some knowledge. The key word there is some, right? just like you're singularly focused on, let's say, providing CFO services, you'll want somebody who's singularly focused on marketing, right, to serve your clients. It might be good to develop some alliances with marketers, right, so that you can make the recommendation, hey, here's who I use if they don't already have somebody. That's a great way to do some networking, right? And like I said, get yourself aligned with people who you trust, that you don't mind recommending to your clients. And then, however you work it out from there, you work it out. Either, they could kick you back some money for the referral, or, I think what a lot of us probably prefer in the accounting community, because it just typically is who we are, is instead of getting any kind of kickbacks, you just say, do me a favor, just take really good care of my client. Just make me look really good, right? That's the best way they can pay you, is to make you look good, to have the client coming back to you saying, all right, I want all my referrals from you from now on, because that's how good these guys are, right? So, digging a little bit deeper into increasing the gross profit piece, this is the part that remains almost entirely in your wheelhouse, right? How can we improve gross profits? Well, we can raise prices, or we can reduce cost of goods sold, like I talked about, right? And again, 2 ways to decrease cost of goods sold. We can either get better pricing by negotiating with suppliers, or shop around, or volume discounts. And a lot of times when you go to do negotiating with your clients or shopping around, the clients with your suppliers, they're going to suggest a volume discount as the way that they can justify lowering your price, right? But sometimes you'll be surprised. You can just call and they'll say, yeah, you know what? You've been a great customer for a long time. Poof, we'll knock 10% off your pricing for the next 6 months or something, You never know. But the point is, you got to take the time and make the calls and do that research, right? Shopping around for better pricing, that option I found is often limited. It's not that easy to do. And like I mentioned before, with the recent trade war with China, there's a good chance your cost of goods sold have gone up if you're buying from China. So if you haven't already, talked to your clients and tell them. I talked to somebody on Facebook who said that her clients were all moving to Malaysia, to buy their products. And what we're finding is you can still get equally cheap and equal quality products, because it's the same kind of cheap labor, but without the trade war in the middle of the mix causing our costs to go up, right? So Malaysia, anywhere in that part of the world, I've been discussing this a lot with friends and colleagues, that this is where you can go. That, to that end, this trade war with China is forcing us to do that. Whether that's good or bad, I don't know. I imagine that's subject to opinions. Ask 3 people, you'll probably get 3 different answers, right? And the volume discounts, I think I already beat up pretty well. Just make sure you have the cash to available to tie it up if that's what you're going to do, or go back to the advertising and marketing model, because if you can increase the turnover, then you can do the volume discounts without having to necessarily tie up a lot of extra cash. That's the way you can kind of balance those two. So it's sort of 2 strategies operating together, intertwined, right? Right. And then let's go back to talking about the expenses, because again, we're back to that. I mentioned in the beginning that I find it's easy to control. But if we look a little deeper at this, the other side of increasing net income, and after increasing the gross profit, if we can, is to look at the expenses. And, what I do, as I mentioned earlier, is I look at this line by line. I run the, one thing you can do, earlier I mentioned I run the P&L totaled by month, right? So I can see the trends. But another one to look at is the expenses by vendor summary. So instead of looking at it by account, you're looking at it by payee effectively. And sometimes that's another way to bring out, and you do this with the owner. You can't do it alone, because you don't have the insights that the owner has into who these people are. And, the owner will often be able to, first of all, they're usually blown away when you run a report like that with them, right? So you get on Zoom, share your screen, you have their books up on your screen so that you can run the report and show them. And a lot of times they're blown away. Like, oh, I didn't know you could do that, because they don't know, because they're not accountants. They don't know what to look for. And that's a big thing where you can really shine these days, because frankly, a lot of people that I talk to, a lot of business owners that I talk to, tell me that their accountant doesn't do this kind of stuff with them, and they don't know what to ask for, right? But if we take the time and proactively say, hey, let's get on Zoom. I'm going to share my screen with you. I'm going to show you your own books, but I'm going to show you how you can cut up this data so we can analyze it and make these decisions. And when you show them an expenses by vendor summary, a lot of times they'll look at something and say, I've had this happen where they've said, I thought we stopped using them, right? Whoever them might be. And then they go look into it and figure out they were supposed to have stopped, and they didn't. And right there, we can cut out a line item from the expenses, just looking at it a different way. Whereas if we looked at that by account, it may not have been as clear. So this is why I complain sometimes about some other accounting software whose reporting isn't as good because I can't get this kind of data out of it, right? That's why I do love QuickBooks Online, because they do have good reporting. And then, of course, as with any accounting product, once we go beyond the basic, the reporting of any accounting product you're going to use is pretty much two-dimensional, right? I can get rows and columns in a report. If I want to go deeper than that and have like subtotaled rows within rows, then I've got to do Excel and I've got to learn how to do pivot tables. And that's why I think those spreadsheet skills are still really important, right? I did this for a client the other day because he was not a client, he's a new prospect coming in, and he's the same one I was talking about before, where I analyzed his books and found old undeposited funds. I also found old receivables going back as far as the undeposited funds did. No surprise there. But what I was able to do that was cool, in my head, I just thought of this and I said, let me play with this. I knew that if I just sent him an AR aging or something, he would probably get it, but it wouldn't really have the impact that I really wanted things to have on him. So I took his, which report was it? It was the open invoices. So it groups it by customer and it shows you everything, right? Dump that into Excel. With a couple of Excel tricks, in less than 5 minutes, I was able to flatten that file out. So I had a two-dimensional database that just had rows and columns. But then from there, I was able to run a pivot table, because really what I wanted to show him was not something you could ever do in QuickBooks Online. I wanted to show him a report that showed him the receivables by year in columns, right? And so that's what I was able to do with a little bit of tweaking. It took me less than 5 minutes to do. And he responded when he, among other things, making it clear, he was very blown away. He couldn't believe how much time I took when he wasn't even a client yet. The truth is, it didn't take me any time at all, because I've taken the time to learn how to do this stuff, and I can do it in 5 minutes, right? But, so these are the things we can do reporting-wise, to analyze data. And that's the thing. That's what our clients need more than ever now, is they need data. And they need to know how, they need that data organized in such a way that they can read it and understand what it says, and then we can work with them to make decisions about it, right? So the expenses by vendor summaries, I would show it to them both ways. Show the monthly P&L, but then also expenses by vendor, also totaled by month, so you can see the trends. That will help you see clearly whom you're spending money with every month on a regular basis, right, versus the sporadic ones. And again, there's opportunities, like I was saying, with the suppliers, sometimes to call these companies and get fees reduced. I did this with several companies myself. Just a few months back, I was like, I haven't done this in forever. And I got my Verizon Wireless bill lowered. I called ADT. This was for my personal, for my home. And I got them to lower the bill by whatever it was. It's a few bucks a month. It adds up, right? It was worth spending the hour or so making these phone calls and just getting for the monthly kind of recurring services. A lot of times, especially if you haven't done it in 6 months, they'll just lower the cost. They'll just say, yeah, you've been a great customer for a long time, no problem. Credit cards, you can frequently call and get the rates lowered, right? So that's something you should do for clients every 6 months, is just call up all their credit card companies, and oftentimes that's all it takes is a phone call and the ask, and they'll say, yeah, no problem. We have a promotional rate right now. We'll give it to you, for the next 6 months or a year, whatever it is, right? And they'll typically let you do that once in 6 months, once in a year. Now, keep in mind, you shouldn't just do this stuff for them. You need to get paid for it, right? So make sure that this is something you do included as a CFO service, not something that if you're charging them, $500 a month to do basic bookkeeping services, taking the time to do this kind of stuff doesn't get included in a service like that, right? You need to be charging extra for providing this kind of analytical type service, right? And it's beyond analytical. You may not be able to make those kind of calls on their behalf. I have some clients who are, it's funny, I joke with them that they're crazy because they put me on everything so that I'm authorized to talk to anybody on their behalf. I develop those kind of relationships with my clients, and we should be looking to build those kind of relationships. They should be seeing us not as somebody they pay for a service. They should be seeing us as their best and closest friend, because we take care of this most intimate and important part of their lives for them, right? And we should be that for them. And that's to me, that's, when I see that I have clients who, especially because they don't want to deal with it. So they say, they call me up or email me and say, Seth, I talked to, the Visa credit card today and your name's on the account. You can call them and talk to them on my behalf. That's when I know that I've accomplished what I've set out to accomplish in terms of the relationship, that I have with them. They trust me to take care of these things on their behalf. Um, and again, so I think that kind of beats it up pretty well in terms of how I can improve profits, how I can, look at a P&L and answer that question. What's wrong with it? Why isn't there enough net income or as much as I think there should be? Again, pricing, volume, cost of goods sold, reducing expenses in a nutshell, that's what I've given you here. But then I want to go back to what I mentioned at the very beginning and remind everyone, for this last part, that all of the above might be completely worthless if we haven't taken the time to review and make sure that these numbers that we're using to make this analysis are 100% accurate, right? Analyzing it all is going to be critical if you're going to help companies increase their profits, but I don't know about you, but almost every company that walks in my door has inaccurate and unreliable financial information. So if I'm basing any of the above on those kind of books, it's meaningless, it's worthless, right? So we have to almost, if we're going to sell a service of being a CFO and doing something strategic or analytical, and this goes back to, for your own practices, how you can have a customer buy from you more than once, and not because you're trying to take advantage of a customer, but because it really fits. The first thing they need to buy from you is the service of cleaning up their books. 9 times out of 10, that's going to be needed. And then you can offer them the service of maintaining their books. And then you can offer them the service of doing the CFO and analytics stuff, right? And it's very rare that I'll agree to do the CFO services if somebody else is doing the books, because I don't know how well I can rely on that information unless, as part of the service, I'm also empowered in a sense to do my own review of the books and satisfy myself that before I, give any guidance, that I can make sure that the books are accurate. So if the company's got their own bookkeeper, that's fine, but I need to build it in as part of the service that I work with that bookkeeper, train them, review things with them, and then I just make sure that I've set myself up for success there. Let me see if I've missed anything. The rest is just the obvious stuff. Like I was saying before, if the inventory is not recorded accurately, then cost of goods sold isn't accurate. There's a point where I was looking at things with a client earlier this year, and we actually were trying to do a very specific unit allocation of all of the overhead costs. It was just kind of a test to see how far we could take it, really. But what was happening was he sells kits, right? And we're managing the inventory in QuickBooks Online, which doesn't really have the infrastructure to deal with kits. So what I've been doing is making inventory adjustments each month. So I run the report that shows me the stock status, and anything that's negative, I have a master list and I know which things are part of kits. And so I just make inventory adjustments to move the inventory to zero out those kits. I take it from the component inventories and move it into the kit inventories, right? Because what it means is that they sell a kit of 5. All our inventory on the reports is shown in the per unit inventory. So the 5 item kit is negative. So I just take 5, whatever, let's say it's negative by 3. So we sold 3 5-packs, right? Which means I need to move 15 units of inventory from the source over to the kit to zero that out and even it out. Well, what was happening was that adjustment, we were offsetting to a cost of goods sold account, of course. And all of a sudden, one month I'm running it and it's way out of whack. It should zero out. We're just moving inventory from one place with the same cost to another. It should be a $0 net effect on the cost of goods sold, on the P&L, or on the inventory balance, rather. So it was going way out of whack. And what we found out was he was way behind on recording his inventory purchases. And so we didn't have up-to-date, accurate cost of goods sold information. Our inventory is off, cost of goods sold was off. And, so I was like, okay, well, I just wasted a bunch of time making all these adjustments. But luckily, those things will pick up retroactively. So I said, fine, go get the bills entered, get one of your staff on it and let me know when it's done and we'll rerun these numbers, right? So these are the things to think of and be aware of. It's almost like you have to see it potentially from every angle and see what could possibly go wrong so that you know how to test for that and make sure that it doesn't go wrong or that it hasn't gone wrong, right? And so the bottom line, the books absolutely must be bulletproof in order for your CFO services to have value, right? And then they can have tremendous value. That's the beauty of this. By the way, I do have 2 free videos that you might be interested in catching. One is currently on Nerd Buzz, which is on the website, on how to clean up your company in QuickBooks Online. So I'll, in the follow-up, I'll send the links out. But also earlier this year, normally I don't do much with desktop anymore in QuickBooks. It's the way I've evolved my business, I don't frankly want to do desktop much, but I started talking more with my friends at CoralTree who make QBox, which if you are in desktop, if your clients are in desktop, in my opinion, they absolutely should be in QBox. It's like a no-brainer. It's ridiculously inexpensive. For like $10 a month, you can have your client files in an environment where you can collaborate easily enough. And I assume you all are familiar with the product. You can tell if somebody's in it, so you can get in there and run reports if you need to. You just can't make changes, and then it'll let you know when the file's available, so you can go in and make changes. It's just, to me, it's crazy not to use this product if you're using desktop. With that in mind, I'll send you the link. Earlier this year, because I started working with these guys a little bit, I created a 17-video series on how to clean up a QuickBooks company in desktop, and it's all absolutely free. All you have to do is put your name and email in this form on the QBox site, and they'll shoot you an email with links to access. The videos are all on Vimeo. So, again, totally free 17-part video series. And of course, you'll be encouraged to try QBox if you're not already using it. So that's my sort of free giveaway for today. And like I said, I'll send those links out in the follow-up. And again, just to kind of recap and summarize, once you've, and you'll see how I do it. You'll see in these videos, whether you do the QBO one or desktop or both, it's basically just going through the balance sheet line by line. And once you've finished the balance sheet, you've probably cleaned up most of it. Then you go over to the P&L and review that. Like I said earlier, just for coding and classification is mainly what you're trying to address on the P&L. Because on the balance sheet, you're really addressing completeness, accuracy, cutoff period, are things recorded in the right period, all that kind of stuff. Is cleaned up effectively when you do the, what we call it in the auditing world is we beat the hell out of the balance sheet, and then we review the P&L. And because that's the name of the game at the end of the day, is I want to make sure the cash balances are 100% accurate, which means we never plug a number, because there's no reason to, ever. It's simple math. Beginning balance plus additions minus subtractions equals ending balance. If there's a difference, it can be found. And going back to the spreadsheet skills, if I really get stuck and I can't find a difference, it takes, again, 5, 10, most 15 minutes. I can download the CSV for that bank statement from that period from the bank. And if need be, I can do an export from QuickBooks, but I can quickly cut up that CSV file, divide it up between additions and subtractions, and then I can sort my reconciliation screen by amount for either additions or subtractions. And usually in 30 seconds, I can find what's off or what's missing by doing that. It takes a second. And by the way, the Bulletproof Bookkeeping course teaches you this process specifically. So for those who don't have that yet, you can, all that is laid out in the whole first section, which is all about bank feeds and getting the idea is I don't want to spend more than 5 minutes a month reconciling any one account. And there's no need to, right? We have the technology so that we should be able to do it. Most everything's been matched up already with the online banking, right? So it's very rare that you even have a difference, but when you do, it can be found and fixed very quickly if you like I said, if you have the right sort of spreadsheet skills that you can use for that. And then, one last time, I'll just, mention it, that once you do have all the books cleaned and current and accurate, then all the stuff I talked about, how to pick apart the P&L and how to figure out what's wrong, well, it's all based on really good information, so it's going to be accurate, and any strategies you build around how to increase sales, lower your cost, or increase your profit margin or lower your expenses, it's all going to be based on sound information. And the strategies, you always have to analyze. Like I said, you have to look at what's the ROI. If we're going to spend money on advertising to increase sales, that's the thing then we have to monitor really closely, because that kind of a cost can really get away from you and kill your profits if you're not careful, right? So we've got to make sure, again, there's always going to be a ramp up period. It could be 3 months, it could be 6 months before we really start to see a return on, marketing and advertising type stuff. So we have to be prepared to give it that, a fair amount of time, which again, for the CFO part, we just do the cash flow analysis, right? If I know that we're committing to or budgeting that we're going to pay a company $1,500 a month, right? Then that's basically, if I'm giving it 6 months, I need to be prepared to spend $9,000, and analyze the ROI along the way. But I basically need to be prepared that I'm going to spend $9,000, and by then, that's when I should start seeing an ROI. But that might be the investment I have to be prepared, or I have to prepare my client to make in order to give it a fair shot. Because if you can't just do it for a month and say, oh, well, it didn't work, right? Again, you'll defer to the marketing experts, but with the little bit of experience I do have in it, I can tell you that, it's not the sort of thing that it's not set it and forget it with marketing, with all this pay-per-click stuff or Facebook ads. It's, the company that I work with, I know several times a week they're analyzing what the click-through rates are, and they're tweaking, they're changing the language. We have A/B tests. We have 3 different versions of the same ad to see, what little tweaks might make a difference, to see if more people click. I've shared the story often that on that very video I mentioned about QuickBooks Online and cleaning up your books, that was something I created several years back as a way of enticing people to give me their email address so I could email them. And when I first put ads out there to try and get people just to, sign up just to get the free video, and I said, free video on how to audit your company in QuickBooks Online, nobody clicked. But when I changed that language to say free video on how to clean up your company in QuickBooks Online, 15 signups a day, right? Because like I said earlier, that audit word is really scary. But cleaning up your books is something everybody can resonate with. And it's something nobody wants an audit. Everybody wants their books to be cleaned up, right? That's the difference. So anyway, anybody have any questions before we go? All right. Well, I hope you all enjoyed it and got a lot out of it. I think this may be the first webinar I've ever done where I didn't share my screen once.
And I was even here.
And you were here. And you got back from the Golden Gate Bridge.
Yeah. It's not that far away.
I think you should be an Instagram influencer.
You think I should, huh?
You never know. You might have missed your calling.
I probably did.
Just put some fake backgrounds on, right?
All right.
See how it goes.
All right. I'm coming to you live from grass.
There we go. The question is, are you smoking it?
That I am not.
Good. All right.
But it is legal here in California.
It sure is. It sure is. All right. Well, you know where to find me if you have any questions or follow-ups, and I'm always looking for suggestions for topics. So let me know.
Thank you.
Thanks, Seth.
All right. Thank you.